Typically, the Bank of England aims for an inflation rate of around 2%. This is seen as a manageable figure, stable enough to keep the economy ticking and the standard of living consistent. In recent times, this inflation rate has become unachievable. In January, the UK rate hit 5.5% for inflation, the highest figure in 30 years. Some are predicting that this could be surpassed in the coming months due to complex factors such as the cost of energy and also food. Runaway inflation is generally bad for saving. Imagine you had £10,000 set aside for a housing deposit. At a reasonable rate of inflation, let's say 2%, you'd need $10,200 to have the same buying power after a year. Although this might not seem like a lot, after 10 years at 2%, you'd need $12,189 to have the same buying power. At the moment, almost no cash accounts offer an interest rate near this level, meaning this problem only compounds for investors over time. The rate of depreciation is already high, but you should always prepare for the worst case scenario. According to some international monetary fund estimates, inflation may not go back to 2% until 2025, meaning money deposited in cash could still lose up to 8.2% in real terms, even if earning the Bank of England's base rate. Alongside this, in some of the most pessimistic inflation scenarios, the real value could drop as low as 10.5%. Due to this, it is important to have proper financial planning in place to avoid your money eroding over time. One of the solutions to the problem would be investing. Naturally, it carries its own risks, but these can be mitigated with a long-term approach to investing and proper strategy of diversification. In situations like one we're in at the moment, when inflation is higher than interest rates, your cash will devalue. From an investor's perspective, it's time to forget about relatively long periods of low inflation that we have enjoyed until very recently. Both COVID-19 and the situation in Ukraine are likely to have a long-lasting impact on inflationary expectations. There are a number of assets, however, that can help protect investors. The first is raw materials, such as commodities, including oil, agricultural products, and of course, precious metals such as gold. Much of the price growth that we have seen over the recent months has been linked to these raw materials. Another asset which helps against inflation is inflation-linked bonds. These are securities which are indexed to inflation, meaning as inflation expectations rise, so does the value of these bonds. To summarize, inflation is an important part of a functioning economy, but at the same time, it can be a headache for people trying to save and grow their wealth. For investors, the important thing is to have a well-diversified portfolio and a long-term approach to investing. It may not be a good idea to leave cash sitting in a low-interest yielding account, losing its value due to inflation. Therefore, if you start investing your cash, you may help mitigate further depreciation of your wealth. If you have some cash that you want to invest, contact our team of investment consultants before the end of the tax year, or if you want to transfer a cash ISA, please do not hesitate to contact us further. Below, you will find a link to book an appointment.